So our speakers today are Michael Orr, Travis Skinner, and Andrew Haitmanic from BKD. Mike has over 25 years experience in the healthcare industry, including 4 years as a payer, 15 years of healthcare consulting, 7 years of provider experience, and was previously a CFO. He has experience with turnaround situations, metrics management implementation, bottom line improvement, managed care contracting issues, and management and revenue cycle process improvement. He is focused on Medicare and Medicaid EHR incentive program reimbursement and audit issues since the inception of the programs in 2011. He holds a BA in economics from the University of Maryland, Baltimore, and an MBA from Loyola University. Travis has over 15 years experience in the healthcare industry with concentration in reimbursement consulting for acute care and critical access hospitals, rural health clinics, and nursing homes. He assists healthcare providers with a variety of reimbursement and regulatory objectives. His areas of focus include the CARES Act, Texas 1115 waiver, cost report and regulatory changes, and reimbursement and how they affect providers. He assists facilities with new ideas and technology, as well as helping with disproportionate share payments, volume adjustments, departmental financial projections, and reviews in both inpatient and outpatient areas of hospitals. Travis is a member of the American Institute of CPAs and Texas Society of Certified Public Accountants. He holds a BBA in accounting from the University of Mary Hardin Baylor. Andrew has over 12 years experience providing accounting and audit services to healthcare providers, including hospitals and health systems, cancer treatment providers, nursing facilities, physician practices, and other entities. Andrew is a member of the American Institute of CPAs, Oklahoma Society of CPAs, and HFMA, through which he has earned the Fellow of the HFMA designation. Andrew holds a BBA and Master of Accountancy from Baylor University. I'll now turn things over to Mike to get us started. Mike?
Actually, Travis is going to start us off, if that's okay.
Not a problem.
Thanks, Travis.
Good morning, everyone, and thank you for joining us, and thank you for having us. Like Shannon said, this is not going to be your normal presentation. This is not for us to come and just sit and present to you guys. We would love for this to be interactive and back and forth. The CARES Act funding has changed dramatically, especially over the last few months and few weeks at that. And it could keep changing. And our job today is to talk about some of those changes and how it affects you, but more importantly, to address concerns and questions that you have. And I can't stress that enough. You're not going to hurt my feelings, you're not going to hurt Mike's feelings, and you're not going to hurt Andrew's feelings. Ask your questions, raise your hands, please. There's not a bad question. Even if it's been covered once or twice, it's fine. The more we talk about this and the more we know, the better. Shannon and I had it and I lost it. Cineva are going to be getting your questions and letting us know as they come in. So we're going to try to answer those real time. But in the meantime, if there's not as many questions or anything to go over, we do have a presentation that we'll work through in those slower times, that we cover the changes in the regulations and the guidance that came out, the revenue recognition piece that we can cover, the reporting requirements, and just some of the changes in the FAQs that's really turned things upside down on us a little bit from what we all knew. Out of the presenters, you're getting 3 different aspects of this. Mike is part of our Healthcare Performance Advisory Services team that's helping you guys. So he's operational, rev cycle, a former CFO and interim CFO. So he has a different way of looking at it than I do from the consulting side and regulatory side. And then Andrew is more of our auditor. So we have all the bases covered on different questions and how to look at that. So the more that we get from you guys, the better ideas we can come up with, the better thoughts and conversation we'll have. Especially, and I can't stress this enough, if your question you think might be, I'm not asking that. That might not be a smart question, or I don't want to put myself out there. I promise you somebody else is thinking the same thing right now. And if not, one of the things we've learned is somebody else might think they know the answer to that or have an interpretation of it that is totally different than what the rules are saying now since they changed. So it would be good that everybody heard it. So we can't stress that enough. Now, On the next slide, you'll see the disclaimers. And we're doing that because it changes. The rules were one way for a long time through this whole pandemic, and then all of a sudden, September 19th changed them. October 22nd changed them. October 28th changed them. And that can keep happening going forward. So basically, there are multiple organizations that are reviewing this and looking at this information and issuing out guidance all from the AICPA and on up to GASB's issued stuff, FASB's issued their guidance. So, and Andrew has a good handle on that, but we need to make sure everybody's aware we are presenting on the information that is available to us and the guidance that is available to BKD as of November 11th.
I think the only ones that have more disclaimers than accounting firms are attorneys.
Probably so. So if the sun rises in the west and sets in the east tomorrow, it's not our fault, I promise. It will change at some point, okay? So the next slide is actually for the grant part of this, that basically it's saying that these contents are ours. This is BKD's interpretations and the what we found from guiding sources and other regulatory agencies there in their interpretations of what we're going through. And again, you know, if the sun sets on the or sets in the east and rises from the west, it's because something happened overnight with a rule change. And
so that's like a disclaimer of the disclaimer.
Pretty much. So we're here to help. We're not going to we're going to try to be the best we can at this and give you the most updated guidance that's out there to make sure everybody's on the same page. And with that, you have to keep in mind, don't shoot the messenger, because some of this is not the best news you're going to hear. Some of it's might even aggravate you because it's not what seemed to be the intent of what all this is. So as we go through this, just remember, we're discussing this and wanting to work with your facilities on this to make sure that we all are understanding what it is as of today and how to move forward the best way possible. So from here, Mike's going to take you down a few of the timelines of how things have changed and some of what has changed.
So we have some other slides that like break out by area or what the different payments and tranches have been. We're not going to cover that in detail. We have a few things of the terms and conditions and what the FAQs look like. This I want to spend a little time on, and I want to take a step back. Part of the services that I provide for BKD are as interim CFO, and I've spent 10 of the last 12 months as interim CFO at a small hospital in Kansas, a 47-bed hospital in Kansas. And when I started there, we had less than 20 days cash on hand. I personally had to go through every check run to figure out how to rob Peter to pay Paul. And it was a really tough situation. And then coronavirus started to hit in the US around January, late January to February. And then we started personally feeling the real hit about mid-March through like elective surgeries that were being canceled and et cetera. So then I want to say it was the second week in April, out of the blue, we got this huge payment that got deposited into our account from the first tranche. And over the next several months, our small hospital received $17 million and had no idea what to do with it and had a ton of money in the bank. But you literally got no backup. You got nothing about like because it's Medicare, they can just deposit right into your account. And you had really no idea, was it the right amount? How did they calculate it? And so the very first FAQs got published on May the 6th. So money has started rolling in already. There was literally nothing. And so everyone was starved when on May the 6th, the first FAQs came out. But I think they answered or they made more questions than questions that they solved. And there have been multiple updates to the FAQs. The first post-payment notice was on September 19th. That was the one that was supposed to come out on August 17th. And if you remember, everybody was waiting like with bated breath for this to come out because it was going to finally clear up what lost revenue was and meant and didn't. And then we had to wait a whole nother month. And then they came out with another post-payment notice, and they actually have issued 2 last clarifications just last week on the 2nd and the 5th. So it's an ever-changing world. And I honestly, my opinion is that it can't stay the way that it is. When you read through everything, there's not a logical consistency. And so I think there's a good chance that it's gonna change again, and soon, probably. So here are some of the things that, actually I'm gonna skip this one. All right, here are some of the things, I'm sorry. We were requested to cover today. So these are some of the big things that have changed over the last few months, and were part of the questions that we asked at the beginning. So the first thing is that the guidance establishes a 2-step process to quantify expenses and lost revenues attributable to the coronavirus. And that's an important thing, because you can't do revenue and then cost. You have to actually quantify the cost. And then if any of the provider relief funds remain after that, then you quantify lost revenue. And that is consistent with the latest guidance as of today. The second thing is how the reporting is scheduled to be done. The reporting should be done by the entity or the tax ID number that received the distribution. There's a couple of caveats. Subsidiaries, if they received a general distribution, that can be reported by the parent, but targeted distributions must be reported by the receiving entity. And that is still the same. That's one of the ones they haven't actually tinkered with. The next one is that the end of the time period over which the lost revenues and expenses attributable can be accumulated was initially put at July 31st, but that was when the reporting was due. So the way they initially wrote it, you can actually have expenses up to the day that the report was actually due. So that was changed to June 30th, 2021, and the report is still due July 31st, but the FAQs still say July, and that is not correct. You actually have to stop attributing on June the 30th. And that is consistent with the latest guidance. So here's another one of the big ones that actually changed. So up until the last guidance, the lost revenue was defined as the negative change in operating income from calendar year 2019 to 20. And it would have had a huge limiting effect. The lost revenues now are to be calculated based on the difference in net patient service revenue from 19 to 20. And we're gonna, Andrew will go through a couple examples to kind of show how that works in a little bit. And that is consistent with the latest guidance. Another one of the things that they didn't change that came out is the definition of expenses attributed to the coronavirus. They clarified and expanded them to include G&A expenses, general and administrative expenses, and gave specific examples like mortgage, rent, insurance, utilities, etc. And that's consistent with the latest guidance. One of the things they did do is they added the word permanent into structures, because initially only purchase or lease of temporary structures was going to be covered. So it's an important addition that permanent structures could now be considered as well. So the next thing is that this was the other polling question. Coronavirus related expenses used to claim PRF are not included in the operating expenses in the operating income calculation for lost revenue. Well, now the coronavirus related expenses do not have to be netted against the lost revenue calculation. That's a big change, and hopefully will help a number of folks. And that's related to the next one, the 2019 and 2020 revenue and expense reporting necessary to calculate the negative change in operating income are required to be presented with quarterly breakdowns. So that's not operating income anymore. That's our difference in net patient service revenue. So that was changed, but the quarterly presentation of the reporting requirements remains. So Andrew, would you like to take us through a couple of examples?
Sure would. Thank you so much for allowing us to be here today again. Really quickly, as we go through, the first example we want to talk about is looking at the identified expenses related to COVID. And before we do that, I think it's kind of important to kind of caveat the fact that where we stand right now is still a little bit unclear with respect to expenses. So, you know, this has changed a couple of different times through the life of COVID and all the COVID legislation and the FAQs. But the important thing to understand is that this initially included a pretty broad definition. Right now, the way it's being translated is that the FAQs have some conflicting examples, but it's kind of believed that expenses relate to incremental expenses related to COVID. So it's a little bit, this is going to be one of those questions that we still have, and we're quite frankly waiting on additional guidance for. The other piece of the question related to expenses attributable to COVID is, does capital related items count? And I know that that Mike just mentioned a few minutes ago, the difference between permanent versus temporary structures. But as many of you have probably heard, the guidance with respect to capital related items did get clarified in the FAQs a couple of weeks ago to very explicitly say that you can't include the total cost of a capital related asset, but that you can only include the 12 months of depreciation or whatever the depreciation was for that particular year. Again, this is going to relate with a lot of questions as to what if I already expended that money on capital related assets. And I fear that we're going to go down the path of quite a bit of litigation in the future from hospitals who have expended monies based on 6 months worth of guidance that has now been changed all of a sudden. So take that all with a grain of salt. But the goal of what we're trying to present to you today with these examples is, what does it look like? So keep in mind the examples that we're presenting here today. So if you see expenses attributable to COVID, those are in essence what we're saying meet the definition of the incremental costs associated with COVID, and we'll kind of assume that they meet all of the criteria. So if you had incremental costs related to COVID, be it patient expenses and G&A expenses, as Mike mentioned just a few minutes ago, they did expand the definition to not just include patient-related expenses. So say you had $8.5 million worth of COVID-related costs that were incremental that you wouldn't have otherwise had. You then have to reduce those incremental revenue or those incremental expenses by the incremental revenues that you received as a result of COVID. So in this case, you're backing out PPP loan proceeds, incremental reimbursement from Medicare. Now, this is obviously a PPS hospital. There are a lot of questions with respect to how critical access hospitals are going to be able to recognize any COVID-related costs at all if they are reimbursed pretty heavily through the Medicare program. So I would call to your attention that there's a lot of questions around that. In addition, we also have, so we presented this to the some Oklahoma hospitals. So OHA grant on that grant line received represents the Oklahoma Hospital Association, who gave a bunch of money to hospitals across the state as kind of like a let's assist our facilities and give back some of this money. I'm assuming there are grants similar to that in many of your states that you are going to have received. If you got that incremental revenue associated with COVID, then you're going to have to reduce your COVID-related expenses dollars that are attributable to provider relief funds by that amount. So in this particular case, the COVID expenses were $8.5 million. You received incremental income of $1.5 million. So the net COVID expenses that you could attribute to the provider relief funds was $6.9 million.
I think we have a question real quick, Andrew.
Sure.
And it looked curious to hear a few examples of what hospitals have spent their PRF money on, you know, HVAC systems, building expansions, imaging equipment, etc. Those are all still, like Andrew was trying to was explaining. He wasn't trying to. He was explaining. Those are still allowable. You can still spend the money on those things, and people have. Facilities have done that. It's just the monkey wrench in the whole thing is now it's not the cost that you get to use with it. It's the depreciation expense that you have up to the first 12 months of depreciation that you can claim. And the issue, if your critical access is, if you run that through your cost report, now you're getting reimbursed by Medicare and you can't claim that against your CARES Act. So some of the other, there was, of course, supplies. One of the big one is bonuses, hazard pay bonuses, hero pay bonuses, things like that. We've heard a lot of people using this money for, to pay their employees for being there through this pandemic.
And that was specifically allowed in one of the middle FAQs.
Right. It came out, they listed it in this 19th one, and it was still there in the 22nd. And then they addressed it in some of the FAQs that you could do basically everybody. Now, again, if you're critical access, those are going to run through your cost report per the way everything is now. So you got to keep that in mind. And there's a couple other examples we can give of the impact of that critical access cost report affecting your CARES Act reporting. Some of the other things that we've seen them spend the money on, besides new equipment, remodeling different sides of clinics and things. One facility I spoke with, they had 2 wings to the hospital. One of them they turned into offices years ago, and now they're going, hey, we don't use them. We don't want that. They were going to work on making that their COVID only wing. So they were remodeling it, getting it up to code to make it their own COVID only wing and go from there.
Telemedicine equipment was a big one.
Mm-hmm.
So one hospital had spent about $800,000 getting telemedicine up and running in a rural community. Beds was another one that we've seen a lot of hospitals purchase new beds to be able to handle COVID patients. Additional
software that you need to help with the add-on of COVID patients that, if you have one software hub that is away from all your COVID patients that the nurses have to come back to do all their reporting and whatnot, adding additional software hubs and license to get that software closer to the COVID section, if you will.
Telemetry equipment was another one, so that you could monitor the patients at the nursing station without having to go into the COVID room each time.
So one of the out there ideas, now, again, this is the 50 Shades of Gray out there. And this was before the FAQs that came out that kind of put a damper on it. But some were even looking at, hey, I'm getting a new ambulance and it is going to be my COVID only ambulance. So if I have to go get somebody out in a rural area to bring back to the hospital, I have an ambulance specific for that. And that's what it's for. Nobody else gets to use it but COVID. It has to have a special place. It has to be disinfected, all of that. And people were looking at it that way. Thinking outside the box was a big deal with this. Now, like I said earlier, don't shoot the messenger, because the FAQs with the depreciation and the fact that the cost report is an other reimbursable source have put a pretty big damper on some of these bigger ticket money items. Andrew, anything on your end?
No, I personally worry that some of the outside the box thinking is what created the need or the feeling within HHS that they want to tamp down on some of the guidance. I don't know that I agree with it, obviously. And most of my rural facilities are going to be struggling pretty hard to keep a lot of these dollars as a result of some of the implications of the changes that they've made. But I think that that's a pretty good list, or at least a good starting list of where you could see the money spent.
Let's see. There's another question.
Yep. So the question is essentially, currently our interpretation of the guidelines is that hospitals who have growing service lines and revenues are going to be penalized. So my quick answer to that is, unless they change the guidance, I do agree that what you are saying sounds like it is pretty accurate. The way that originally the FAQs specifically identified or talked about lost revenues was that it allowed for, quote unquote, any reasonable method to be used to compare prior year and current year actual lost revenues, or to go a little bit further and allow you the opportunity to look at budget versus actual, thus kind of providing that opportunity to right size or adjust your revenue streams if you had changes year over year. at this point right now, the guidance that they've been putting out in the post payment notifications and other FAQs has provided literally no opportunity for some kind of a comparison that gives you leeway in that sense. And so what we're really worried about is that the organizations that had really strong 2019s, poor 2019s, and into 2020, you saw some improvements in revenues and some improvements in other areas. You're going to probably see a decrease in your ability to demonstrate lost revenues, especially if before the COVID actually hit, you started seeing some pretty strong improved revenue streams, or you, for example, got a new doctor in late in 2019, or you added the new service line that's going to be generating lots of revenue for your organization. Those are probably going to end up, unless the guidance has changed, negatively impacting your ability to claim some of these provider relief funds based on lost revenues.
And Andrew has a couple examples of that he's fixing to get to.
Yeah. So let's get into that really quickly. So just a couple of brief examples of what lost revenue looked like. As we talked about a few minutes ago, the guidance from the September post-payment notification had essentially said that instead of lost revenues, the organization should be comparing their operating income year over year. Luckily, one of the things that the Rural Health, the Hospital Association, American Hospital Association, HFMA, a whole bunch of organizations lobbied to HHS and said, this is really not the right way to approach this particular portion of the lost revenues calculation. And so as a result, in October, they changed that guidance back to literally a comparison of what were lost revenues. And what they landed on was lost revenue in 2020 calendar year versus revenue in 2019 calendar year. And we're not going to get right now into all of the revenue recognition portions for those who aren't calendar year, 12/31 calendar year ends. We can have that conversation if you'd like. We're more focused on whether you can keep the money as opposed to what year it goes into. But in the example you have in front of you, it looks as if we had $61 million in net patient service revenue in 2019 compared to $46.9 million in 2020. As a result, that's a $14.5 million loss of net patient service revenue, or decrease in revenues. That represents the amount that you could claim in provider relief funds if your expenses don't exceed that amount.
Well, that's what I was going to say.
If your expenses do exceed, yeah, so keep going. And on the next example, kind of along the same lines, if you actually had, and maybe this goes back to your question from a few moments ago, if you had a really good late 2019 going into 2020 and your actual patient care revenues increased year over year, so say in this case, from $61.5 million to $67.5 million. So almost a $6 million increase in patient care revenues year over year. That's going to represent to you no ability to claim lost revenues related to the provider relief funds. So I have a few organizations kind of in both camps, but if you do have increases in revenues calendar year over calendar year, that's going to limit your ability to claim those revenues for the purposes of provider relief funds. And then if you go one more slide over, and we can answer some questions, but I really wanted to highlight a couple things on the provider relief funds guidance. I mean, there's a lot of questions that go along with it. We don't know answers to some of these questions. And when we do, it may alleviate some of the concerns that you have, or may help feed into that guidance of, okay, I feel more comfortable now that maybe I can keep or not keep some of these dollars. We need additional clarification on how to deal with the one-time expenses, including the capital related items, that they've pretty clearly said you can only capture 12 months at most of depreciation. That is unclear at this point, and quite frankly, like I said a few minutes ago, subject of what I assume will be quite a bit of litigation in the future. There is no opportunity, or is there going to be an opportunity in the future for the normalization of revenue streams? As it stands right now, there is none. Again, we just talked about that. There will likely be different answers between the financial statements, the single audit, and the provider relief reporting with respect to the revenues that you recognize. Now, for the 1231 organizations, 1231 year-end hospitals, that may not be as significant, but obviously for your 930 and 630 and all the other fiscal year-end organizations, you're going to see quite a bit of variation between what you report on the CFAR, the schedule of federal expenditures, the provider relief fund reporting, and then also the actual financial statements. How we handle cost report settlements on non-1231 year ends is a conversation that some of the auditors and cost report reimbursement folks within our firm, as well as everywhere, are having. The question is, if you don't have some kind of a minor settlement evaluation at 1231, 18, 19, and 20, how can you really have a full comparison of what the revenues were for your organization for each of those periods? Because if you are non-1231 year end, those cost report reimbursement and settlements are going to fall in different periods, and they're going to skew the numbers. So there's some questions with respect to exactly how to handle that. What is a marginal increase in expenses? We talked about that a few minutes ago, but I still have personal questions with respect to what is a marginal expense. For example, if you have employees that you didn't terminate, or you didn't RIF or put on some kind of a furlough system, but they're instead doing a different job than they normally were, does that count as a marginal expense? Or if they were already employed and they're still employed, is that a marginal expense? Seems to me that it would be reasonable to include them, but I don't know. And then what does reimbursed by other sources really mean? There's still a lot of questions. I think that's firming up, but there's still questions as to exactly what that means. So I just wanted to identify for everyone, there are a lot of questions. We do not have answers. If people do have answers, like with solid, factual, like I know what the answer is, either they're really, really smart and they're smarter than me and they can predict the future, or they just think they know all of the answers, because I got to the point 9 months ago where I said, I can't tell you what the answer is anymore, because it's going to change a lot. So just know that it's changing, and we're going to do our best to address those questions as they stand right now. And when they change, we'll do our best to notify you when they do.
Hey, Andrew, real quick,
Sure.
Stay on this slide, Mike. I know there's a couple questions that we're going to get to in the chat box, or at least a question and a statement. But just so everybody knows, because this is a question I get all the time, and it's actually one that right now we kind of know the answer to, and it's a super easy question. Is let's pretend we're not a 1231. Let's pretend everybody's a 930 year end. Okay, so you'd have your cost report that's due 930. You would have your financial audit through the 930 year that would be due after that. Your 930 cost report would be due after that. But your single audit, even though that runs through your 930 year, we're still waiting on the protocols for that. Right, Andrew? So that might be done well after the fact, but it goes back to your 930 year. The provider relief funds is not on your fiscal year unless you're 1231. That's why I said pretend everybody's a 930. So if everybody's a 930, yeah, you still have your financials and you still have your cost report that runs through 930. But when we start looking at PRF reporting, that is everybody's on a calendar year. So that's something just to keep in mind is what we're reporting, and why Andrew said there's different answers for each one of these. That's why, because let's say as the rules are right now, and we're all still 930s. Well, anything, the way the rules are now, remember, anything, and we're critical access, anything we put that we've expended runs through our cost report. Well, if that's deemed, as it is now, a reimbursed by other sources, we'll need that information off the cost report for your financial audits for the 930, but then we've got to do it again from 10/1 to 12/31 for any PRF funds that are expended between that period. So you'll probably have to have a short period cost report for the 12/31 time period. And then again, anything that you spend from 1/1 to 6/30 could have to have another short period cost report. So unless they change those rules, that's kind of the talk in the reimbursement community of having to figure out what part of that is reimbursed by Medicare in order to give to the auditors so they know on their reporting for the financials, and then again for the PRF fund reporting at the end of the year. So just to clarify, just so everybody knows that these have different dates and different timelines, that's a big question I always get, and I'm glad Andrew covered that, because they're different. And for a lot of hospitals across the country, this is their first single audit they've ever gone through. So that's going to be a new story for them as well.
On a related topic with that, a lot of our cost report people were confused because they thought they needed to recognize the PRF funds that were received when they were received. And that is not the case. For, like, example, for single audit, it's only when the funds are actually expensed, and you have to have more than $750,000 expensed. So for instance, for a 6/30 year end, there's a decent chance that maybe they didn't actually expend that much of the funds by 6/30, and they might be able to avoid a single audit for 6/30/20.
Okay, good. So one of the questions, let's go back and let's see. Can third-party settlements from prior years be excluded from net patient service revenue in 2020?
Yeah, and I will take this, but then I'll let you finish it off, Travis, because I think you probably are you're the reimbursement expert. But my guess would be it really depends. But first of all, for critical access hospitals, I think that's why I sort of meant when I said it's almost as if we're going to have to do some kind of a cost report estimate at 12/31/18, 12/31/19, and 12/31/20 for each of the critical access hospitals, so that you can get what is revenue for each of those periods. So it's almost like a cutoff. It seems kind of ridiculous, but at the end of the day, I don't see how you get around it, because yes, I believe that the third-party settlements need to be put back into the periods that they truly represent for the purposes of a really good comparison between calendar year 20 and calendar year 19. Those implications may not be as significant for the PPS hospitals in the room, as they're not cost reimbursed, and so they're not going to have as much of an implication. Although I could be corrected and say there's some rural health clinic expenses or something along those lines that need to be taken into consideration. But the critical access hospitals really need to be aware that that's probably the biggest piece of the puzzle, is that there are going to be some implications from a third-party settlement perspective.
We just filed a cost report this week for a critical access hospital that had $700,000 in bad debt reimbursement. So it can be pretty significant. And there's a real good chance that they won't get it on interim. They had problems with the bad debt the year before and had it all removed. So it could be a year or two before that actually settles out.
Good. No, and I completely agree with what you said, both of you, of what you said. And I think that's part of Andrew's, we still don't know, because there's a lot of things that if you start comparing 19 to 20, well, we did things in 19 different than 20 because 20 was a pandemic. Can we get those in the same, how do we get apples to apples in that net patient service revenue? So I think that's something they have to clear up, but I'm with Andrew that it definitely needs to, we have to start siloing things to make sure we're looking at things in a better light, to make sure we're comparing everything correctly.
Yeah, and I'll follow up on the next question. Is really, it's really just it's a kind of a point, and I think it's really important to reiterate. So I'm going to say it aloud. So thank you, Kayla, for sharing that with everyone. But yes, I agree with you. Kayla pointed out that many of the hospitals across the state of Missouri have been reaching out to representatives, governor, the senators, to really kind of help reiterate the implications that these changes are going to have on rural hospitals, and especially critical access hospitals who have this mechanism of reimbursement through Medicare. Please, we're doing the same thing in Oklahoma. I imagine that's happening in Texas and across every state that's represented here. Please reach out to your legislators, especially those who are in the Senate and the House, who, quite frankly, passed these rules with the intent of not returning all of this money to the federal government after holding it for a few years, especially given the new rules essentially say, hey, if you put it in the bank, we want the interest back too, because that's one of the new FAQs. You may not have heard that yet, but one of the FAQs followed up in the last few weeks said, if you put this money into a bank account and earn interest on it, we expect you to reimburse us for that interest at the end when you return that money, or if you got to keep some of that money, you got to offset with the interest that you earned throughout the life of holding those dollars. Please reach out to your legislators. Let them know how this is impacting your organization, because it's not just your organization. It's every critical access hospital across the country. It's many of the hospitals, whether they're critical access or not, who receive PPP loans. I think PPP loans are going to be one of those things that may end up coming in as an incremental revenue that offsets those incremental costs. And as it stands right now, that's going to have a pretty significant impact on most of our rural facilities and the facilities that are reimbursed through critical access hospital rules.
So Andrew, if I can, I have an example that's right on top of on the top of mind about that, exactly what you were talking about, because we have been in talks with, here in Texas, we have the Texas Organization of Rural Community Hospitals, TORCH, and THA, and they've been on the horn with the legislatures trying to get them to see how you're asking the Medicare trust fund to reimburse COVID expenses really only for critical access hospitals and not for PPS. And it's a little different. So they're trying to make those arguments. But one of the examples I can give, because I was just on the phone with a 1231 critical access hospital yesterday, it said they had to say they're buying a ventilator for $10,000 and it has a 5-year useful life. They're going to place it in service at 12/1. So out of the straight line depreciation, it's $2,000 a year. Well, they get 1/12 of that $2,000 for the depreciation they would collect or calculate through 1/1/20 through 12/31/20. Okay, well, that comes out to about $170 approximately. That $170 then goes through their 12/31 cost report. Okay, say they're at 50% Medicare reimbursement. Now that cuts it in half to $85. So they're saying it would say Medicare paid $85 out of that 170. Even though you spent $10,000 because you paid for it up front, you can only claim $85 for the CARES Act funding. Then if you got into the next year from the 1/1 to 6/30, right? And this is saying you didn't get PPP loan, you didn't get anything. All you have as other reimbursement is your Medicare cost report. Well, the next 1 to 6/30, you would get, that's half of the $2,000 for the full year. So you have $1,000. That runs through another cost report at 50% Medicare reimbursement. Now that's only $500. So 500 is reimbursed by Medicare, 500 units. So you could say, call it $600 out of the $10,000 that you can claim as CARES Act reporting and overall, and they're going to look at you and go, well, we need $9,400 back. So that's, remember, don't shoot the messengers, but that's exactly why Andrew made a huge point about this, of making sure they understand how these FAQs really don't meet the intent of what everybody expected the money to be for.
Do we have any other questions come in?
The one about the slides, I thought there was one more.
Well, while we are waiting, if you, while we're waiting, if you don't mind switching over to really briefly to slide 29, I would love if you'll push it forward. It's the one, GASB Accounting for Provider Relief. The one thing I want to call to your attention, and please continue to ask questions, because I'm just going to fill a few more minutes of time on something I think is probably pretty relevant to many of your organizations. We're more focused on, can you keep the money? Some of the accounting and revenue recognition questions are what period it falls into, whether it's, if you're a 6/30, if it's 6/30/20, if you're a 9/30, whether it's 9/30/20 or 21. But the one thing I did want to call to your attention that maybe you hadn't heard yet, and this is pretty new based on GASB, or the Governmental Accounting Standards Board's reaction to some of the changes that took place. But I wanted to call your attention to the fact that GASB has essentially come to the conclusion, and they pinned it on one of their already existing statements, to say that if there is a requirement, a timing requirement with respect to meeting the requirements to keep the provider relief funds, in this case, the calendar year comparison, 2019 versus 2020, then you can't recognize lost revenues until that calendar year requirement is met. So for all of our non-12/31 year ends who have been thinking that they were going to recognize quite a bit of revenue at year end with respect to the provider relief funds and lost revenues specifically, just understand that won't be taking place this year. It's a timing issue. If you met the criteria for lost revenues from 2019 compared to 2020, it will be flowing through. So if you're a 6/30 year end, that'll be on your 6/30/2021 financial statements or your 9/30/2021 financial statements, because you won't have met the criteria from a timing perspective until you have fully hit that calendar year mark at 12/31/2020. So that's just a big one to me. A lot of my hospitals were a little bit surprised by it. They're not so overwhelmingly concerned because it doesn't really matter as long as they can keep the money, but it's a pretty big deal to a lot of our facilities.
Good point, Andrew. Very good.
Sorry, I'm reading the question from Kayla. Has anyone been including all salaries from nursing staff, radiology staff, et cetera, as an allowable expense under COVID funding? I'm just wondering how other healthcare facilities are separating out COVID specific salaries from others.
I can tell you a lot of the facilities here in Texas created their own code or their own GL grouping to try to keep track of that. And that's been pretty functional to help, because again, we're getting back into that incremental, what is incremental expenses, and what were you paying them to do COVID over and above if hey, they're on a 20/80 time frame and they're working overtime because of all this COVID. Are we keeping track of that separate? Is that the only incremental, or like Andrew alluded to earlier of, hey, our volumes tanked, like there was non-existence. We can't keep this person, but we did anyway. And is that an incremental cost? So there's ways of doing that. I think for personnel, as in, did you hire this person specific for COVID? Did you have to hire more housekeepers or more disinfecting staff, or security? Did you have to hire security for your facility that you normally didn't have? Those are things that you can include. But if you just said, hey, we're going to put everybody that's on payroll as a COVID related cost, that's, I don't know if that's incremental enough to calculate that way.
And please be aware of the Paycheck Protection Loan Program. If you received the Paycheck Protection Loan Program, you would essentially need to offset any salaries related to COVID by the receipt of those dollars. And the way I understand it, it's if you got the dollars, then irrespective of when you apply for the forgiveness, because that was one of the first thoughts I had was, could you delay the timing of when you applied for forgiveness to not have to include those dollars in this particular calculation? HHS was all over that. That's in an FAQ explicitly saying, if you had a mechanism for reimbursement, you have to include that mechanism for reimbursement and offset those expenses. But I would suggest continuing to track those separately, because as we've already made it pretty clear, we don't know where we're going to land with all of this, what exactly they're going to come to the final rule. And so it could change again, providing more or less opportunity to claim some of those expenses. The more you have separated out now, the better you will be in the future, and you won't have to invest a whole bunch of time hunting for what you thought might be a COVID-related expense last year.
Now, with that, two things I want to bring up. Number one, having them separate, like Andrew said, that's huge. That helps with your all reporting purposes, your financial audit, your single audit, your PRF, the audits that are coming down the road after this is all over. That helps there. When you get to your cost report, having them all in one bucket, and then you make a bunch of A6s and whatnot to get it moved out of there to the rightful cost centers might be something you think about, because there's not, as far as right now, there's not a COVID cost center on your cost report to report those. Number two, the difference between the personnel and the fringe benefits. So remember, I talked about earlier, there was the bonus that you can give. And that bonus, you know, the hero pay, hazard pay bonuses to your employees, that's considered a fringe benefit. So it's not part of that incremental, you know, increase that you have to worry about with the personnel. Now, the difference, the reason why looking at it kind of big picture is, why is a bonus okay versus giving them an hourly rate, average hourly wage increase or increasing their rate, is because what they don't want to happen, and they've said this with some of the targeted distribution that they've given out, what they don't want to happen is you say, let's pretend everybody in your hospital makes $30 an hour. And you go, I've got 5 million in the bank. Everybody's going to make $40 an hour. Well, that's fine because you have the money now until you get to next June. And then you have to report and you go, oh, well, some of this isn't allowable. You owe all that money back. Now it becomes August and we can't afford to pay everybody $40 an hour and you have to start cutting people. That is not the intent and not what they want. They put that in writing that that's not what the money's for. They're more for, hey, do it. There's the executive 2-level salary base that you have to be aware of, but the lump sum bonuses for their time during the pandemic is what they're looking for you to do with it, as opposed to an hourly rate increase. But good questions. The more the better. How are we looking on time, Shannon?
We're getting close to the end of our time together, so I'm going to have Cinnaba go ahead and pull up the post-polling questions. They're the same as the pre-questions, so please take a moment to answer those for us. And while she's pulling those up, please feel free to continue to type your questions into the chat box. We've got a couple minutes left together, or if you'd like to share any comments or questions, don't hesitate to unmute as well.
While y'all are taking the opportunity to answer a couple of these questions, I will leave you with one last unhappy note, I think, is the way I look at it. I have heard a lot of rumors in the past, or questions from clients that say, hey, I've heard rumors that HHS is eventually just going to forgive all of this and just let us keep the money. And while I love that idea, and I think it clearly falls in line with the intent of helping our facilities, especially our rural facilities who are already hurting, on November 4th, they literally released an FAQ that addressed that and essentially said, if you do not spend the money in accordance with the guidelines, meaning COVID-related costs or lost revenue, then you will have to return the dollars. So it kind of felt like a gut punch a little bit to those who hoped that maybe there was a chance that they'd let you keep the dollars, even if you didn't spend it in accordance with their rules. At this point, I just want to reiterate that that's probably not the way they're going to land unless some pretty significant changes happen over the next few months. And as we already know from a political perspective, those could and possibly will happen, but I certainly wouldn't roll the dice on that as we stand right now.
Woohoo! Well, sort of. The results of the first question are 100% correct, and it's still 50-50. It was 44-44 before, and it's 50-50 now. And the correct answer is B. They do not need to be offset against lost revenue calculation as of the latest guidance.
Thank you.
Thanks for your time today.
With that, we'll definitely turn it back over to you, Shannon. Thank you.
Thank you. Thank you, Mike, Travis, and Andrew, for your time today. And thanks to the Delta program participants for joining us. I hope you found it beneficial. And as always, don't hesitate to reach out to us here at the center. If you do think of follow-up questions, we're happy to connect you back with BKD. And have a great weekend, everybody. Hang in there.
Thank you all.
Thank you.
See ya.